Hello traders, this is Blake Morrow with ForexAnalytix, and you are listening to the week ahead video for January 26, 2020. I still can't get over saying 2020. Sounds so strange. But anyway, hope you guys are having a great weekend. Obviously this weekend, it's a pretty big weekend for, news. I think everybody's just, pretty much staying close to the wires, listening for, any new updates on the coronavirus. And from what it seems like it is progressing. It's getting a little bit worse. A lot of people have actually, made similar correlations to like the SARS epidemic of several years ago. And it's still too early to assess, but I think it is having an impact on obviously risk appetite. It's probably until we start to see it subside. We're probably going to continue to get, some pretty. We're going to just have to stay on top of the, on top of the updates. One of the big issues I think, if you're talking about, the coronavirus and what's happening, is that it's happening at what couldn't be a worse time for China. For the Chinese New Year, the Lunar New Year. You got a lot of people that have been traveling around the country. And so when you have a virus that seems to be easily transmitted, the risks are obviously tilted to the upside, that the transmission might be a little faster, more aggressive, because you have so many human beings traveling around China, and not only China, in and out of China. So because of that, I think we have to stay really on top of all the news headlines from the major news outlets. There's a lot of garbage on social media, and so you're going to read a lot of fear mongering and whatnot. But I think it's important to watch the major news organizations, whether it's Bloomberg or CNBC or Reuters, or some of the just major news outlets, so you can stay up to date on all the headlines and whether there's some sort of containment, or maybe even a cure, or maybe the epidemic is slowing down. But as you can see, in equities, it really it had a real negative impact at the end of the week. This is the S&P on the daily chart, and we had an outside day. If you look at the, whoops, that's intraday. Let's go to the weekly candle. Weekly candle is an inside week, so actually it might be a little dark cloud cover setting up. But the fact of the matter is, markets are elevated globally, and so that actually puts in a near-term risk of near-term pullback. And so some of the currencies that are going to be most affected are going to be like the yen pairs. If you look at the dollar yen, I know I've made a big stink about it on on Twitter. Obviously, if you listen to the daily face webinars, you've heard my analysis constantly about the big trend line reversal. A lot of people were not looking at what I consider the right trend line. A lot of traders weren't looking at the very long-term weekly trend line. They were looking at more of a near term from the end of 2018, which it did look like a breakout. Here, let me pull it up on my chart. It did look like a breakout going into the last couple of weeks. Everybody's like, oh, it's above 109.70, it's bullish. But I think most people were ignoring the longer term. You can see the dotted trend line here, the longer term dotted trend line, and that did give us a reversal. And even before the coronavirus really picked up notoriety, if you will, the dollar yen was really struggling. I mean, it spent, obviously the latter half of the week, the notoriety, I guess, is the proper term to use. But many people started worrying more about the coronavirus, and so that obviously strengthened the yen. But you go to the beginning of last week, we were still struggling, even when equity markets were making all-time highs. And so that was kind of our first clue. And there are going to be repercussions. It's not just the yen pairs, and you can see the euro yen, for example, is sliced through the 200-day moving average below a key trend line. Frankly, it looks like the euro yen is going to dip below 120 and maybe back down towards 118, 119. The euro's been trading heavy. I'll talk a little bit about that here in a moment. But you can see like the Aussie yen's below the 200-day moving average. The New Zealand yen, which has been very, very bullish as of late. We pushed below, let's just say roughly 71.70, and definitely below 71. You're going to see a much bigger pullback in the New Zealand yen, maybe back down towards 70. So this is a lot of space below current price that we can really open up if things deteriorate globally with risk aversion. Okay, so you should keep an eye on the yen pairs, but also I wanted to talk about gold. Like, a lot of people have been trying to lean on gold, saying, oh, it's a false breakout and divergent. There's so much open interest with speculators trying to buy gold. But frankly, if we have a little bit of risk aversion, gold's going to continue to rally. And I have to admit, just as we talked about this several weeks ago, when we were building this flag pattern right here, and you can go to the weekly chart and see that flag pattern, frankly, the pullbacks have been very minor. When you have just a very shallow pullback in the market, the risk is that you're going to get a continuation. That is for, if you're looking at a bullish move and the pullbacks lower have been very minor, you always hear me say, well, what does not go down only has one other direction to go. Very similar situation with gold. It's not going down. So as everybody's trying to short it up here, and then obviously if risk aversion picks up, we're going to blow right through the 1600 level. And remember, the bullish target for this longer term flag comes in above 1700. So you got to be a little careful with gold, especially with this this outbreak picking up steam and I don't want to say popularity, but obviously the Google searches for coronavirus right now are really picking up as everybody's paying very close attention to it. So people are going to look for a safe haven. That usually comes in the form of gold or yen. Now we can talk a little bit about the euro and what the euro is doing. But before I do that, I'm going to take this moment actually to mention this. So give me a moment to mention that, guys and gals, if you haven't used ForexAnalytix or you've been on the fence to use it, this is the time to take advantage of it. We have actually extended the offer past the 24th. You can see where it says sign up today. That button will disappear, and then we're going to go back to the normal trial offer in a few days, or in 2 days actually. We extended it over the weekend. We had a few people that had requested that we keep it up. They're probably transferring money or whatever the case may be. But these offers, the next time you'll see these prices or something even similar to these prices will be in September of this year. So we usually do that at the end of the summer, beginning of what we call the trading season. So if you're on the fence about using ForexAnalytix, take advantage of this offer. We have a great deal that we don't always give out. And then obviously we have the light version that's not on special, but with both of those versions, whether it's the premium or the light version, make sure you download the mobile app. If you're using ForexAnalytix, you've got to be using the mobile app. This way you'll get notified when there are support and resistance levels breached, a new update comes through on your analysis type for your specific pair that you can completely customize. You can get notified that way. It's awesome. You can access the chat room through the app. It's great, and so I highly recommend you do that. All right, enough about that. Let's go ahead and move on. So let's talk a little bit about the euro dollar and actually what's happening this week, because we have the FOMC rate decision on Wednesday. On Thursday, we have the Bank of England. There is other data coming out, but those are the two major central banks that we'll be paying close attention to this week. But the euro, as you guys know, I mean, we closed on our lows. All right, and the reason why the euro closed on the lows, in my opinion, are twofold. Okay, so the first reason was we had the ECB meeting. First, Christine Lagarde meeting happened this last week, and some people were hoping, probably those that had been shorting the dollar at the beginning of the year, noting that every bank was saying, hey, we should be short the dollar. That's the trade of 2020. I think you have traders that were wrong-footed, that are just getting out, and they hope for the Hail Mary that that Christine Lagarde was going to be more hawkish, pull out from the playbook of the Riksbank this last week, and that did not happen. So that poor positioning in the euro dollar has led to euro selling at the end of last week. Now, also, listen to what I have to say about this. What I feel is misplaced optimism about the dollar being the safe haven currency, I think took place at the end of the week as well. I say misplaced because I want you guys to hear what I have to say. The dollar is viewed and has for such a long time as the and let me pull this up really quick. I'm going to do something else. Okay, pull up the dollar index. Actually, you know what? I'm going to pull up the dollar, and I want to draw something out for you guys. I'm going to use that. The dollar index has been used for a long time for being the safe haven currency of choice during periods of risk aversion. I think that this analysis in this current market environment is not correct, at least not right now. Okay, the dollar index is the ultimate safe haven currency, or I should say the dollar, not the dollar index. The dollar is the ultimate safe haven currency. Maybe, maybe the yen is. Maybe the yen holds that mantle, but or that crown, excuse me. But the dollar is definitely something that's used and bought during periods of risk aversion. I do feel that that is the case. All right, for the most part. But what I do feel is the dollar index is used as a risk off instrument when we have severe risk off. That means when the markets are really coming under pressure. If you look at, this is a weekly chart of the dollar index, and I'm going to compare it to the S&P. All right, let's do it like this. It's not gonna be perfect, but you're going to get what I have to say here. All right. So if you look at the S&P, all right, the last time we saw a pretty big sell-off, which is in the end of 2018, the dollar actually went down. It started to go up. You see that? It started to go up here, and then it went down as the S&P was going lower. All right, you see that? Okay. You can also see dollar, or here the S&P went down pretty aggressively. I mean, the dollar was kind of moving up at that point, but when there was like a kind of a sharp move down, the dollar didn't necessarily respond positively. Now, I feel that if the market was really concerned that the S&P was breaking down like for good, let's just and define for good, but I'm just saying, let's just say that the market felt that the S&P was coming down and it wasn't going to come back anytime soon. At that point in time, I think that the dollar would be used as a risk off a hedge, if you will. But if you're looking at this current chart, and let me see if I can move this out just a little bit. I'm trying to draw this the way I want it to be drawn. So in other words, if the S&P really came down, and then it looked like it was breaking like all these uptrends, I think the dollar would actually perform well. All right, but as you can see during this period of risk aversion, we sank 20% here in the S&P. The dollar actually just kind of floundered around. I still feel that that's going to be the case, and the reason why I say that is because the dollar or let me take that back. The euro has been a carry trade funding currency for the last several years because of the difference between where the Federal Reserve has their interest rates versus the ECB, which is at zero. All right, so the euro, and you can do that equation against a lot of different currencies. The euro has been used as a funding currency. So if carry trades do get unwound because stocks come down, right? I don't think the dollar is necessarily going to go up. I believe that the dollar is going to probably drift sideways to go down or go down. Now, again, if stocks actually, we're down more than 20%, it looks like, like I said, it looks like the stock market's not going to come back for what people perceive as for good, like, oh my God, the stock market's never going to come back. Then I think the dollar would eventually turn higher, right? That's what I think. So what the reason why I'm saying this is because if you're in the camp that, oh, the euro is going to parity, right? You're let me delete this here. Let me get rid of that S&P. Okay. So if you're in the camp that you're like, oh well, the euro is going to parity and it's going to be dropping below 105 and yada yada yada. I actually don't believe that to be true. I think the euro is probably more range bound than anything. So we're currently trading around 110. Let me do this. Actually, let me reset that and then I'll zoom. Okay. So the euro, is around the 110 level. I think it'll bounce somewhere down here, probably off of all the support, somewhere down in these levels, and then, bounce a little bit. So, what could cause that? Well, this week we have the FOMC. So the FOMC, even though we're not expected to have any groundbreaking, big change in rates or change in posturing from the FOMC, one thing that most people will be looking at is looking at how they're, how much liquidity they're putting in the market, especially in regards to the repo market, and if they're making any technical adjustments to those dollar amounts. And so, that has the risk of putting some downside pressure on the dollar. Maybe that is what puts a bottom in the euro near term. That combined with continued deterioration in the S&P 500, where maybe we pull back 2, 3, 5%, whatever the case may be. All right, so that's something, in my opinion. I believe that the idea that the U.S. dollar is the safe haven currency of choice right now, I believe that's a little misplaced, at least at this stage in the game. Again, if things get out of hand and this coronavirus is much more serious than I believe it ever will be, but let's just say it is for argument's sake, then the dollar will be used as there'll be a nice little shortage there and people will be buying dollars left and right. But for right now, I think the euro's got a lot of support around 110, below 110, that we have to pay pretty close attention to. Technically though, we do have a head and shoulder pattern, and there's a lot of people that are leaning into this and playing it on the short side. One thing's for sure that I've noticed in the last 20 some odd years of trading, especially technically, is head and shoulder patterns are the probably the highest failure rate of any pattern that you see here. So it wouldn't be surprising to me to have everybody targeting below 109 in the euro dollar, and it drops right to 110 and then reverses and takes out all the shorts. That to me would not be surprising at all, knowing the history of reliability of a head and shoulder pattern or an inverted head and shoulder pattern. Okay, so it wouldn't surprise me at all if we just did an about face and started rallying. Okay, last that I want to talk about today really is the cable. The cable's been under a little bit of pressure, but remember, this is Brexit week. I actually am pretty constructive on the euro, or on the cable, excuse me. I wouldn't mind buying it. I just have to buy it at a price that I feel that is acceptable of me taking on risk of being short dollars. So where is that level at? Maybe it is back at 130. So somewhere like this. This broken triangle in this previous trend line, maybe somewhere down here around 130, maybe 130.50. But this will be Mark Carney's last meeting. There are a few MPC members that are, starting to dissent, and they think that there should be a rate cut. And it depends on what the other members are thinking this time around. But this is Mark Carney's last Bank of England meeting, and I know from the people that I know that live in the UK, they cannot wait. This day has not come. I don't know if they're more excited about Brexit happening finally this Friday, this next Friday, or Mark Carney not being the head of Bank of England. But probably most people in the UK just are pretty happy, just in general, that both of those events are happening this week. So anyway, but guys and gals, I want to thank you for listening in, and remember, if you like this video and you think it's going to be helpful for you next week, make sure you give us a thumbs up, when you're watching us on YouTube, and subscribe to our channel so you don't miss any of the wonderful, interviews that Dale Pinkert does on the FACE webinar. We really appreciate it. It always helps us out, and gets the whole team excited about providing all this free content to you guys and gals. But I want to thank you for listening in. There are a lot of other things that are happening this week. I mean, we got durable goods here in the U.S. We have advanced GDP. We have Canadian GDP at the end of the week. There's PCE data, or some of the Fed's favorite inflation data coming in at the end of the week. So there are a lot of events, but I think most people will be paying very close attention to the coronavirus and monitoring what's happening there. If you are listening in from Asia, or anywhere in the world for that matter, make sure you wash your hands. Wear masks if you have to, but stay safe, and take care, everybody. I hope to see all of you back here next Sunday for the week ahead video. Thanks for tuning in. My name is Blake Morrow with ForexAnalytix. Have a great remainder of your weekend.